Welcome to the Deep Dive. Today, we're digging into a company that, well, it feels like it's right at a crossroads, you know?
Mm-hmm.
You could see it one way, a high-growth stock finally starting to show some profit muscle.
Right.
Or you could see it another way, a business where there are still some pretty big risks maybe hiding under the surface. We're talking DraftKings. DKNG.
Yeah, it's a really fascinating one. I mean, the industry they're in, online sports betting and gaming, it's got to be one of the most dynamic and, frankly, complex spaces out there right now.
Totally agree. And you, our listener, you've sent us a whole pile of sources on DraftKings articles, reports, financial data, the works. It covers everything from their basic business model to the super tricky regulatory stuff, the numbers, who owns the stock, the risks.
It's a lot to wade through.
It is. So our mission here is to cut through all that noise. We're going to pull out the really important bits, the insights, maybe some surprising things, those aha moments, really help you understand what's actually going on with DraftKings. And we're looking at it specifically through the lens of the underlying business itself, its health, its ability to actually create value.
Right, moving past the headlines and, looking at the fundamentals, are they building something solid?
Exactly. So here's the game plan. First half, we build the foundation. What is DraftKings today? How do they actually make money? Then we'll look at who's running the show, the management. And then a serious look at the financial health, the numbers.
Okay, and then in the second half?
Second half, we zoom out. How does the market see them? Who are the big owners? And crucially, what are those big unavoidable risks we mentioned?
Got it. Business, management, financials, then market, ownership, risks.
Yep. And definitely stick around till the end. We've got a question we want to leave you with, something to really think about. Can DraftKings actually make that jump from being this, high growth, high spend company to one that consistently generates profit and value for shareholders long term? Or do its unique challenges, especially around the financials and, frankly, the company structure, make it a different kind of animal altogether?
That transition is always the tricky part, isn't it? Especially in an industry like this one. So much change, so fast.
Absolutely. Now, before we dive into the sources, just a quick mention.
Yep.
If you find these deep dives valuable, please hit that like and subscribe button on the Stock Analytics AI YouTube channel. It really helps us out.
Yeah, it does.
And a huge thank you to our members supporting us at the Euro $4.99 a month level. Your support means a lot. And remember, that membership gets you prioritized deep dives. You give us a ticker, and we'll often bump it up the list, sometimes getting an analysis out right after earnings. Helps you get the info you need quicker.
Okay, ready to jump in?
Let's do it. DraftKings. Okay, everyone knows the name, right? Seen the ads. But what is the actual business today? It's more than just fantasy sports now.
Oh, way more. At its core, yeah, it's a digital sports, entertainment, and gaming company. U.S.-based. It started, like you said, with Daily Fantasy Sports, DFS, way back in 2012. That's how they built the brand initially.
Right, that initial recognition.
Exactly, but they've expanded, massively since then.
Just how are they bringing in the money these days? Because DFS, like you said, it feels like a smaller piece now.
It is. The vast majority of their revenue, the sources we saw put it around like 93% in 2024, comes from two main things. Online sports betting, OSB they call it, their sportsbook, and iGaming, which is basically online casino games, slots, blackjack, that kind of thing.
Gotcha. Okay, let's break down the sportsbook part first. How does that work? Are they like taking the bets and hoping the customer loses?
No, it's not quite like that. They make money from what's called the hold. Think of it as their gross gaming revenue, GGR. It's basically the difference between all the money wagered by customers, that's called a handle, and the money they pay out to the winners. They set the odds to have a theoretical margin built in, but, and this is really key, that margin, that hold percentage, it can bounce around quite a bit based on actual sports results. If you have a weekend where, say, all the favorites win easily, or there are lots of outcomes that lots of people bet on correctly, well, their hold percentage goes down. And that directly hits their revenue, their profit for that period.
Wow. So the actual game outcomes on the field can swing their financials. That makes sense, but it really drives home the variability, doesn't it?
It really does. It adds an inherent volatility.
Okay. And the iGaming side, the online casino, similar idea.
Yep, similar concept. Also based on a hold. With casino games, the house always has a built-in edge, mathematically. So DraftKings makes money from the gross winnings they keep as players, play the games.
Right. Beyond those two big ones, sportsbook and iGaming, what else is in their toolkit? You mentioned they're building an ecosystem.
They are. DFS is still there, though smaller. They've got their mobile sports betting app, the iGaming app, and importantly, They talk about using their own proprietary tech, like their own betting engine. They even have an in-house studio making exclusive casino games.
Interesting. In-house tech.
Yeah. Plus, they have some physical retail sports books in certain locations. They've got a media arm, the DraftKings network, putting out content. And most recently, they bought Jackpocket.
Jackpocket? What's that?
It's a digital lottery courier service. Basically lets you buy state lottery tickets through an app. So they're adding lottery to the mix now. They even dabbled in NFTs a while back, digital collectibles, though that seems less of a focus now.
Okay, so the strategy seems pretty clear. Be the go-to place for anything related to sports and gaming online. Keep people on the platform.
Exactly. Engage users, cross-sell them different products, keep them sticky.
So how big are they really in this U.S. market? Is it just them running the show?
Oh, definitely not just them. But they were a clear leader. The sources consistently describe the U.S. online sports betting and iGaming market as effectively a duopoly. It's mainly DraftKings versus FanDuel.
Right, FanDuel. You see them everywhere, too.
Yeah. Between the two of them, they control a huge chunk of the market, often cited like above 65%, and it's neck and neck. One source mentioned DraftKings actually pulled slightly ahead in handle recently, maybe 36.7% versus FanDuel's 34.8%. Really tight.
Wow. So just those two dominating.
Mostly at the top, yeah. But there's also what the sources call a second tier. Companies like BetMGM, Caesars, and now ESPN Bet. They keep the pressure on.
Keeps them honest, I guess.
You bet. As for DraftKings size, they have the biggest footprint, live in 26 U.S. markets as of 2024. Market cap was around, $31.8 billion in early June, serving almost 5 million active users last year. So, yeah, they're substantial.
So why pick DraftKings? If I'm a customer, what's their main selling point versus FanDuel or BetMGM?
Their pitch really centers on technology and the customer experience. They push being mobile first, having technological innovation, aiming for a seamless and friction-free app. They want to be seen as the tech leader.
Okay.
And also, crucially, responsibility. In an industry that gets a lot of scrutiny, they heavily promote their commitment to safer play resources and responsible gaming. That's vital for trust.
Definitely. Okay, let's zoom out to the industry itself. Is this whole online betting thing just like a flash in the pan, or does it have real staying power?
The sources seem pretty convinced it has a strong long-term future. There's still a lot of growth potential, especially here in the U.S., as more states come online.
Right. The legalization patchwork is still unfolding.
Exactly. Projections show U.S. online sports betting growing like 12% a year through 2032. Globally, maybe 10% through 2030. And technology keeps pushing it forward, too.
How so? What kind of tech?
Things like AI and machine learning for personalization, showing you bets you might like. Real-time data analytics. New ways to bet, like micro-betting on the next play in a game. Or more in-play options. Esports is another growth area. Plus, partnerships. And just the general shift people are moving online. Online gaming share of total commercial gaming revenue hit almost 33% in Q1 2025, a record.
So the tide is definitely flowing towards online. But you mentioned that fierce competition again. What does that do to the business?
Well, that intense fight, especially between DraftKings and FanDuel, leads to things the sources call price wars and aggressive marketing. Basically spending tons of money to get customers.
Yeah, you can't watch a game without seeing their ads.
Exactly. And all that spending puts pressure on profit margins.
Yeah.
So they try to differentiate. Maybe DraftKings leans on its tech. FanDuel pushes its popular same game parlays, trying to stand out.
And then there's the regulation minefield. That sounds like a nightmare to navigate.
It's incredibly complex. Since the Supreme Court decision in 2018, it's all state by state. Different rules, different licenses, different tax rates everywhere.
Must be expensive.
Hugely. Sources estimate it costs them maybe $15, $20 million a year just for compliance across all the states they're in. And taxes can change. Illinois just raised its rate, which hits profitability directly. Plus, there's growing pressure around consumer protection, responsible gaming, fraud prevention.
So regulation allows them to exist, but it's also a massive cost and a constant risk.
That's a perfect summary. It enables growth, but adds huge operational and financial burdens.
Given all the regulations, the tech needed, the marketing spend, how hard is it for someone new to just show up and challenge DraftKings or FanDuel?
The barriers to entry are really significant now. You need massive amounts of capital just to get licensed in enough states. Then you need even more to build a brand and acquire customers against these established giants.
Plus the tech.
Right, you need sophisticated tech. And the big guys already have economies of scale, tons of customer data. It's really, really hard to replicate what they've built at a national level unless you have incredibly deep pockets and something truly different to offer.
Okay, so let's recap this first part. DraftKings, digital gaming leader, makes money mostly from the hold in sports betting and casino. Industry's growing long-term, but competition is brutal, regulation is costly and complex, and building this kind of business is tough. High barriers.
That covers the business landscape pretty well. Now, let's shift to the people actually running this complex operation, the management team.
Right. Still led by the co-founders, yeah. Jason Robbins is CEO.
Yep, Robbins is CEO. Paul Lieberman handles technology. Matt Kalish is president for North America. Their story is really about taking it from a startup idea to this market leader position in a brand new industry.
And they've definitely weathered some storms along the way. I remember the whole daily fantasy sports legal mess back in, 2015?
Oh, yeah. That was intense. Huge legal scrutiny, regulatory battles in multiple states.
Yeah.
They navigated that.
And then going public via SPAC in April 2020, right when COVID hit and all sports just stopped.
Exactly. Talk about timing. Their core product evaporated overnight, right as they were listing. Pushing through that showed some serious resilience, some drive. Robbins has even said that kind of dealing with chaos is part of their DNA now.
Okay, so they've shown grit. What about recent performance? What have they delivered lately?
Well, 2024 was pretty significant. Revenue grew 30%, hit $4.8 billion. And crucially, they hit positive adjusted EBITDA for the full year, $181 million.
Adjusted EBITDA, okay. Not GAAP net income yet, but positive on that adjusted measure.
Right. And maybe even more importantly, they generated positive free cash flow for the first time ever in fiscal 2024. That's a big milestone. They also added 3.5 million new customers, supposedly at record low acquisition costs.
Okay, so proven growth execution, starting to deliver on adjusted profitability, and now generating actual cash. That leads to the big question, right? Especially for you, the listener, thinking about that transition we talked about. Can this team actually guide the company to sustained GAAP profitability?
That's the multi-billion-dollar question, isn't it? Making that final step from adjusted profit and cash flow to consistent, real net income.
And how open are they, communications-wise?
You know, standard public company stuff, earnings calls, reports, an investor relations site. They aim for succinct messaging, according to one source. But for investors really digging in, true transparency means talking openly about the challenges, making those non-GAAP numbers really easy to track back to GAAP profit or loss, and giving substantial answers in the Q&A.
And ethics, responsible gaming, especially critical in this space.
They definitely emphasize it. Responsibility is stated as a core tenet. They talk about investing a lot in compliance, player protection, the safer play tools. The sources didn't flag any major ethical scandals, which is good. But it's an area demanding constant vigilance.
So let's try to answer that key management question then. Are they honest, capable, and shareholder-oriented?
Honest. Seems like standard practice based on their stated commitments, yeah?
Capable. I mean, the track record speaks for itself, right? Scaling the business, getting through crises, hitting those recent growth and adjusted profit numbers. You'd have to say yes, they're capable operators.
Agreed. Shareholder-oriented. Now, this is where it gets more complex.
Yeah.
Especially if you're looking through that traditional value investing lens, focus on alignment.
Why the complexity there?
Well, historically, the strategy was absolutely growth first, spend whatever it takes to get big. And that led to years of negative return on invested capital, ROIC. We'll dig into that more. But basically, the money they invested wasn't earning back its cost. That's not fundamentally shareholder-friendly in the long run.
Right. Growth isn't always value creation.
Exactly. And then there's the whole ownership structure itself.
Ah, the dual class shares. Let's unpack that.
Yeah. So they have Class A shares, which is what the public buys, 1 vote per share, and then Class B shares, held mostly by insiders, the co-founders. Those carry 10 votes per share.
10 votes. So that means...
It means the insiders have overwhelming voting control. One source estimated CEO Jason Robbins alone controls something like 90% of the total votes.
90%. Even though institutions own most of the actual stock, the economic interest?
Correct. There's a huge disconnect between economic ownership and voting control. Public shareholders have very little say in board elections, major strategy decisions, M&A, etc.
That's significant. And you mentioned something about insider transactions, too.
Yeah, this adds another layer. The sources highlighted data from the 6 months before May 2025. In that period, there were reportedly 44 open market sales by key execs Robbins, Lieberman, Kalish, the chief legal officer, the former CFO.
Okay, 44 sales. And how many buys?
0. 0 open market purchases reported by those same executives in that time frame.
Wow. 44 sales, 0 buys from the top leadership team.
Right. Now, people sell stock for many reasons, but that kind of consistent one-sided pattern, many investors see that as a potential red flag. It raises questions about how aligned management's economic interests are with public shareholders who are buying and holding the stock. You ideally want to see leaders keeping skin in the game, maybe even buying more if they truly believe it's undervalued.
So it complicates that shareholder-oriented assessment, even with the recent positive FCF and a small share buyback, which are positive signs the governance structure and that selling pattern are things investors focused on alignment will definitely notice.
It's a nuanced picture for sure. They
Yeah.
talk about long-term value, but the structure and actions raise questions.
Okay, let's pivot to the hard numbers. Chapter 3, financial health. Give us a snapshot.
All right, looking at data around early June 2025, TTM Q1 2025, market cap was about $31.8 billion. Trailing 12-month revenue, around $5 billion. Adjusted EBITDA, positive $102.6 million in Q1 25. But the bottom line, TTM net loss, still in the red, negative $398.6 million.
Still losing money on a GAAP basis.
Yeah.
So a PE ratio is meaningless here.
Right, totally negative. The market's clearly pricing in future growth and, importantly, future profits. Price to sales TTM was around 6.4x. Price to free cash flow based on the FY24 number was quite high, around 78x.
And revenue growth. Still strong, but slowing down a bit.
Yeah, it was explosive earlier, but now it's settling into still very strong territory. 30% growth in FY24, 20% in Q1 25. Their guidance for FY25 is around 32% growth at the midpoint. Impressive, but the huge base makes those earlier triple-digit jumps harder.
Makes sense. What about profitability margins? Are they actually getting more efficient as they grow?
Gross margin is improving, which is good, around 38% TTM. But those GAAP operating and net margins are still negative territory. Net margin TTM was about minus 8%. That gap between the GAAP loss and the positive adjusted EBITDA shows the impact of things like stock-based compensation, depreciation, other adjustments they make.
Okay, so the path to actual consistent GAAP profit really relies on getting those operating costs, especially marketing, to grow way slower than revenue, right? That operating leverage idea.
That's the whole ball game. Management says they are starting to see that leverage, that expenses aren't growing as fast as revenue anymore. That's the key to unlocking GAAP profitability.
Let's check the balance sheet. Debt. How's that looking?
That's an area of concern for some. The debt-to-equity ratio is high. Sources put it between 132% and 211% recently. Total debt is pretty chunky, somewhere between $1.3 and $1.8 billion. They do have cash, but they are in a net debt position.
High leverage on a company not yet consistently profitable. Definitely something to keep an eye on, especially in a potentially volatile industry.
For sure. But offsetting that somewhat is the free cash flow story we mentioned. That's the big positive shift.
Right. The first time positive FCF in FY24. How much was it again?
Between $330 and $400 million, depending on the source. And TTM Q1 2025 FCF per share is 0 to 81 cents.
That is a major turning point, and projections are for that to grow.
Yeah, projections are strong, maybe $850 million in 2025, potentially over $1.4 billion in 2026. That positive FCF gives them flexibility, reduces reliance on capital markets. It's crucial.
Okay, flexibility is good, but now let's hit that metric you mentioned earlier, the one that really gets to the heart of value creation. Return on invested capital, ROIC.
Yes. This asks, how effectively is the company using all the capital, both debt and equity, that's been invested in the business over the years?
And for DraftKings, the answer is?
Well, this is probably the toughest number from a traditional value perspective. Their ROIC has been consistently deeply negative. TTM Q1 2025, it was minus 12.15%.
Minus 12%. And how does that compare to their cost of capital? Like, what return should they be earning?
Their estimated weighted average cost of capital, or WACC, is around 13.9%. So you have an ROIC of minus 12% versus a cost of capital of almost plus 14%.
Oof.
Yeah.
That's not good. They're earning way, way less than what the capital cost them.
Exactly. A consistently negative ROIC, especially one that far below the cost of capital, fundamentally means that, from an economic value standpoint, all the money poured into growth so far has not generated returns sufficient to cover its cost. The growth, viewed strictly through that economic lens, has actually been value destructive up to this point.
Okay. So wrapping up the financials. Still not GAAP profitable, but improving on an adjusted EBITDA and, importantly, now generating positive free cash flow. Balance sheet is okay on cash, but high debt is a flag. And the big one, persistently negative ROIC suggests past growth hasn't yet created economic value.
It's a fair summary. Now let's pull back and look at the wider context. Second half starts here. Chapter 4, market sentiment. How does the market generally feel about DraftKings?
Well, it's definitely seen as a leader in a hot growth sector, high growth stock. That's the main narrative, though it is shifting a bit, starting to incorporate the improving financials like the adjusted EBITDA and FCF.
So the valuation reflects that optimism, high expectations baked in.
For sure, which means the stock price is pretty sensitive to news, right? Anything about how they're executing, new regulations, competition, even those sports outcomes we talked about.
Makes sense. What about the Wall Street analysts? Are they buying this story?
Generally, yes. Very bullish, actually. The median price target in May 2025 was up around $57, $59, which was quite a bit higher than where the stock was trading in early June, like low to mid $30.
Wow, big gap.
Yeah. Most analysts had buy or outperform ratings. One source noted 0 sell ratings at that time. So the collective wisdom on the street seems to believe they can deliver on those high expectations.
Interesting consensus. But hasn't recent news been a bit more mixed? Didn't Q1 earnings have some wrinkles?
It did. They reported Q1 2025 earnings in May. The headline numbers beat estimates. Revenue and adjusted EPS were better than expected. Revenue grew a solid 20% year over year. So far, so good.
Okay.
But they trimmed their full-year guidance slightly, lowered the forecast range for both FY25 revenue and adjusted EBITDA. Not by a huge amount, but still a trim.
And why did they lower guidance? What was the reason?
Management pointed to a couple of things. Those customer-friendly sports outcomes hitting the hold percentage again in Q1, and some regulatory impacts. Also, the Jackpocket acquisition, the lottery app, while it adds users, it actually lowered their average revenue per monthly unique payer, ARPMUP, because lottery players maybe spend less than sports bettors or casino players.
Exactly. ARPMUP was down 5% in Q1 to 108 pounds. So the acquisition was dilutive to that key metric initially. It shows how integrating acquisitions and external factors can create bumps.
And then there is more bad news on state taxes just recently, right? In June.
Yep. Another reminder that the regulatory environment is a constant overhang. These things show the stock's volatility and how sensitive it is to stuff outside their day-to-day operations.
What about short sellers? Are lots of people betting against DKNG?
Actually, not really. Short interest seemed relatively low, around 5% of the float back in May. That's lower than some peers. And the days to cover how long it would take shorts to buy back all their shares was also low, under 2 days.
So not widespread conviction that the stock is going down, at least among the short sellers.
Doesn't seem like it now. Okay, let's shift to who actually owns this stock. Chapter 5, ownership structure.
Okay, institutions own a lot of it. Reports vary slightly, but somewhere between, say, 47% and over 84% is held by big institutions.
Like who? Big names.
Yeah, the biggest holders are firms like Vanguard, BlackRock. Vanguard had almost 9%, BlackRock around 6%, so it's definitely widely held by professional money, which also means it can be influenced by big fund flows, right?
Sure. What about the insiders, the management team we talked about? How much do they own?
Their direct economic stake is actually pretty small, around 2.5%, but remember...
The Class B shares, the voting control.
Exactly. They hold those super voting Class B shares. We mentioned earlier, CEO Jason Robbins reportedly controls around 90% of the votes.
So institutions own most of the money interest, but insiders control the company decisions.
Precisely. And then layer on top of that the insider selling pattern we discussed.
Right, the 44 sales and 0 buys in that 6-month period leading up to May.
Yeah. And for investors who really prioritize management having significant skin in the game alongside them, that combination, low economic ownership, high voting control, and significant recent selling is a definite corporate governance concern. It raises serious questions about alignment.
It certainly weakens the influence of public shareholders and insulates management quite a bit. Governance is definitely a key factor here.
Okay, let's try to pull all these threads together now. Chapter 6. Risk assessment. Let's do a quick SWOT analysis based on the sources. Strengths, weaknesses, opportunities, threats.
Okay, strengths. Powerful brand, leading market share, their proprietary tech, that large active user base, and the recent positive turns in adjusted EBITDA and free cash flow, plus expanding our product offerings.
Weaknesses. Seems like we hit a few.
Yeah. The history of grab losses is still there.
Mm-hmm.
High marketing and customer acquisition costs historically, that intense competition squeezing margins, the complex and costly regulatory landscape, that persistently negative ROIC is a big one, high debt levels, and the governance concerns around the dual-class structure and insider control selling.
All right. Opportunities. Where could things go right?
Lots of potential. More states legalizing online betting and gaming is the big one in the U.S. Potential to expand internationally eventually. Growth in iGaming, which tends to have better margins than sports betting. using tech like AI to improve the platform and profitability, building out their media content strategy, more partnerships.
Okay, sounds good. And threats.
Yeah.
What could derail things?
Regulation is always top of the list. More states raising taxes, like Illinois did, or unfavorable new rules. Competition getting even worse, maybe leading to irrational pricing. An economic downturn is a major threat. People have less discretionary money for gambling.
Good point.
Cybersecurity is always a risk for an online business. And backlash over problem gambling, leading to stricter advertising rules or limits. And, dependence on those key co-founders.
And there was that interesting indirect threat you mentioned earlier, U.S. tariffs. How does that fit in again?
Right, it's not obvious.
Okay.
But the analysis suggested broad tariffs could slow down overall U.S. economic growth and maybe push up inflation a bit.
Which means less spending power for the average person.
Exactly. Less money for discretionary things like placing bets or playing online casino games. It just adds another layer to that economic slowdown risk.
Got it. An indirect macro headwind. Okay, this brings us to the end, Chapter 7. Conclusion and wrapping it all up.
So DraftKings, clearly a major player, a leader in a fast-growing, exciting market. They've shown they can grow revenue dramatically. And to their credit, they've recently made real progress on adjusted profitability and, very importantly, started generating positive free cash flow.
Yeah, those are definite positives. But when we look at it through that more critical lens, focusing on the fundamental business health and long-term value creation, the sources highlight some pretty significant concerns, don't they?
They really do. The fact that they're still not consistently profitable on a GAAP basis, that really concerning, persistently negative return on invested capital, suggesting past investments haven't actually earned their keep yet. The high debt load on the balance sheet, and those governance issues, the dual-class structure giving insiders near total control despite low economic ownership, combined with that pattern of insider selling. These are all serious points for an investor to weigh.
So what's the overall take then?
It's absolutely a growth story, no doubt about that. And the financial trajectory is improving in key areas like cash flow. But does it have the hallmarks of a truly durable, predictable, value compounding business, like a classic Buffett-style investment?
Based on the data points we discussed.
Based on the negative ROIC, the high debt, the governance structure, those are pretty big hurdles for making that kind of case. It looks more like a bet on continued execution and future profitability rather than a proven compounder today.
So success really hinges on them finally translating that market leadership and revenue growth into sustainable, high returns on the capital they invest. Actually making the business consistently, truly profitable in an economic sense.
Which, looking at the historical ROIC, hasn't happened yet. That's the challenge ahead.
And that leads us right back to that question we posed at the very beginning. Can DraftKings really make that difficult transition from being this high-octane, high-spend growth engine into a business that reliably and consistently compounds value for its shareholders over the long haul, especially given its financial history and its governance setup? What does that stubbornly negative ROIC really tell us about the economic value, or maybe lack thereof, created by all that growth so far? That's the core question for you to wrestle with.
The really critical consideration.
Well, that wraps up our deep dive into DraftKings based on the sources you sent us. Thank you so much for joining us on this exploration.
Yeah, it's always fascinating to unpack the different layers of a business like this one. So many moving parts.
And just one last reminder, please do like this video and subscribe to the Stock Analytics at AI YouTube channel if you found this helpful. And for our members at the Euro 4.99 a month level, thanks again for your support. Remember, you can request tickers for these prioritized deep dives. Great way to get analysis, especially around earnings season.
And the necessary disclaimer. Please remember, this discussion was based entirely on the source materials provided to us. It's purely for informational and educational purposes. It is absolutely not financial advice.
That's right. Investing involves risk, potentially significant risk, including losing your investment. This content was generated by AI, working only from those sources.
So it's crucial, absolutely essential, that you do your own thorough research and due diligence. Always consult with a qualified financial advisor before making any investment decisions based on your own personal situation.
Thanks again for listening.